Before we start this video, do like and subscribe to our channel and not miss on any updates.
Now, coming to Accounting Standard 22 that deals with taxes. Now, Accounting Standard 22 talks about how should we calculate, how should we present, how should we compute the expense or benefit on taxation, right? Now, for this, you need to have a basic understanding of Income Tax Act of 1961, basic understanding, right? Of course, because you are writing group 1, I presume you would have already completed significant portion of income taxes as well. And how do we compute or how do we calculate accounting income? So these two understanding is very, very important, right? I'll give one small scenario to build the concept and then we will move ahead to the concepts of the standard. Now, as far as accounting income is concerned, we'll follow the schedules of the Companies Act, we'll follow the accounting standards, we'll compute the expenses, and we will figure out, yes, this is how the income or expense has to be calculated. So you'll have some line item. Say for example, sales. I'll put one number, 10,000. Cost of goods sold. I'm not following a proper Schedule 3 format. This is just for understanding. 8,000. Assume this 2,000 is my profit before depreciation. This is profit before depreciation. Then let us say there is depreciation of 500. So you have profit before tax of 1,500. Profit before tax of 1,500. This is called income as per books, or you can also call it as accounting income, right? This 1,500 becomes my accounting income. Now, income tax works very differently. Income tax is whatever you have calculated as per your books, I don't accept it. You have to compute the income as per my rules, as per my regulations. So when you come to Income Tax Act, income tax is all this depreciation, whatever you have calculated, I don't accept. So then what do you accept? You have to calculate depreciation as given in the provisions of section 32. Right? You don't need to remember the rates. The question will give the rates and all of that in the examination. But income tax is this 500 is not acceptable to me. So then what is acceptable? Assume for a moment 400 is acceptable. Income tax says I will allow only 400 of depreciation as a deduction. Then what happens? Instead of 1,500 as income, I will have income of 1,600. As per what? As per tax provision. This is called taxable income or income as per taxation. Okay, 1,600 is as per taxation, 1,500 is as per books. Now, 2-3 things you keep in your mind while solving questions on Accounting Standard 22. One thing that the income tax wants is calculate tax on this 1,600 and pay tax on that 1,600. So how to calculate? Now for companies there is a flat rate. For individuals, of course, will not be tested. For capital gains, we have a different rate. All of this will be given to you in the question. All right. So, 1,600 is the income. Assume for a moment 20% is the income tax rate. 20% is the income tax rate. So, 1,600 multiplied by 20%, you have 320 as your tax payable. Okay, I'm ignoring cess and all for the moment, but 320 is the tax payable. This tax payable, what you calculate as per the income tax provision is called, what is it called? What is it called? The tax that you calculate as per the provisions of the Income Tax Act, that is called current tax. That is called current tax. Okay, till here, understanding is not difficult because you have been doing income taxes, you will be able to understand this. Now, the problem or the challenge comes when the accounting standard says that, see, you have charged 500 of depreciation here. You have charged how much? 500 of depreciation. Income tax says 600 of depreciation. There is a mismatch. Sir, why is there a mismatch? My expense is 500 here. My expense is 500 here, but for tax purpose, for calculating income tax, I have calculated or I have reduced 600, not 500. So there is a mismatch. We have violated the matching concept. So accounting standards prescribe that to ensure matching concept is there, you calculate what is the impact of this difference. Now, what do you mean by impact of this difference? In my books, I have charged 500 of depreciation. For taxation, I have charged 600 of depreciation. Now, in future years, see today what has happened. See this, year 1, books, tax. Books it is 500, tax it is 600. Maybe in year 2, books will be 500, tax will be 550. Maybe in year 3, books will be 500, tax will be, no, sorry, I'll just revise the example. So assume we have books and we have tax. In year 1, books had how much? 500, tax had how much? 600. Maybe in year 2, books will have 500, tax will also have, say for example, 500. Maybe in year 3, books will have 500, tax will have 400. So what happens is, today income tax says take a higher deduction. Income tax says take a, okay, I took 400 here. So I missed the number. I'll again do it. Sorry guys, because I was thinking I took 600 there. Did some of you put a comment here? Okay. I'm revising the example. I thought I took 500. So again, books was 500, tax is 400. In year 2, books is 500, tax also is 500. In year 3, books is 500, tax is 600. Of course, it will not be such a streamlined reversal, but just for example. So in year 1, what has happened is, income tax says, I will give you lower deduction. So this resulted in higher taxable income. Here, there is no difference. In the 3rd year, it became lower taxable income. Now, think of it. There is a difference. Because of this difference, in the 1st year, I had to pay a higher tax. But in future, because I have paid higher tax here, in the 3rd year, I have to pay a lower tax. So this is called deferred tax. This is called deferred tax. Deferred tax means for the future, shifting it to the future. Now, what the standards require is, these differences cause a mismatch between accounting and taxable income. You have to calculate the tax impact of that so that the expense that you have charged in the books and the tax that you show in the books is aligned. Now, what do I mean by that? Here, I have to pay higher tax today. How much did I pay? 1600 into 20%, I paid 320. And because of this difference, there is a difference of 100. Because of this difference will give me some kind of benefit in the future. It will give me some kind of benefit in the future. That benefit which I get is called a deferred tax asset. So on 100 multiplied by 20%, I get how much? I get 20 worth of deferred tax asset. This is a benefit. This is a benefit. So what does this benefit represent? This benefit represents a future reduction in tax liability in the 3rd year. So when you come to the 3rd year, in the taxation you get a higher deduction. So assume this income is still 1500. So what will happen at that point of time? 1500 minus 100 of extra depreciation, you get 1400. On this, if you apply 20% taxation, you get tax of 280. You have to pay only 280 of tax. Here you have to pay 320 of tax. This extra 20 gets offset here. So here we say we have reversed the DTA. The reversal is how much? 20. So when it comes to tax expense is equal to current tax plus or minus deferred tax. In year 1, it became current tax of 320 minus asset of 20. Why minus asset of 20? If I am creating an asset, it gives me a benefit in the future. It is a benefit, so I am reducing it from my expense. So this became 300. In year 2, there is no impact. In year 3, it became 280 plus 20. This 20 I am reversing now, and this also became 300. So matching concept is followed when we try to do deferred taxation. Now, one thing I want to make it very clear here is, in real life, this will not exactly match like this because taxation rates are different, reversal timings are different. So all of those factors will be there. But the underlying logic is, whatever expense I am charging in the books, my tax expense should reflect those expenses. If I am getting some kind of benefit from taxation, or if I have to pay something extra for taxation, it will have a future impact which I have to show it in the books of accounts, right? So this is how the concept of deferred taxation works. The logic that you have to remember is, taxes paid today and future. If taxes to paid today is higher, sir, why will it be higher? Disallowances by the Income Tax Act or some income which is taxed earlier. So if the taxes paid today is higher, which will result in a future reduction of taxes, this will create a scenario called deferred tax asset. This will create a scenario called deferred tax asset. And if taxes paid today are lower, in future I have to pay a higher tax. This will create a scenario called deferred tax liability. Now, here, if you see, first we paid higher tax, in future there is a lower tax. So in year 1, it created a deferred tax asset. And in year 3, that deferred tax asset got reversed. Okay. So two things you have to keep in mind. One, tax expense is equal to current taxation plus deferred taxation or deferred tax impact. And if taxes paid today is higher, in future if I have to pay lower tax, this becomes a DTA. If taxes paid today is lower, this result in higher taxation, this becomes a DT. Are we clear? Any questions here? Okay, great, perfect. Now, Accounting Standard 22, Accounting for Taxation Income, deals with the taxation impact and focuses on matching concept, basically matching expense against the revenue for the period. So whatever expense you have charged, whatever expenses you have created, the taxation impact should also reflect that. Then few important terms I have already discussed. Accounting income or loss is the net profit or loss before taxation for a period as reported in the statement of P&L. So this is your profit before taxes. Taxable income is the amount of income or loss for a period as per tax laws. What is relevant for us? Income Tax Act of 1961. Now, two things you have to keep in mind. If the question gives you the tax rate, if the question gives you how to calculate, follow that. Okay, don't take as per tax, this is there, this is wrong question. No. If nothing is given, you can assume rates of income tax is applicable and you can accordingly do it, right? Then current tax is the amount of income tax determined to be payable or recoverable. Recoverable could be if at all there is a kind of a refund in respect of the taxable income for the period. So current tax is taxable income into tax rate. And deferred tax is the effect of timing difference. Now what is this timing difference? I gave you an example where there is a depreciation impact. Every year there is a difference. First year tax has given us lower deduction. Next year there was no difference. In the third year tax has given a higher deduction. So that is called timing difference. So there are two types of differences what you need to understand. One is timing difference and the other one is permanent difference. Timing difference is something or a difference which arises in one period, For example, in year 1 it has arisen. This will be subsequently reversed in the subsequent periods. So if there is something which arises in one period and are capable of reversal in one or more subsequent period, this is called timing difference. Classic example is depreciation, and most of the questions are based on depreciation in your questions or in the exams. Permanent difference are those which originate in one period and do not reverse subsequently. What is the meaning of this? There is a difference. For example, interest income exempt. Now, interest income exempt, will I show it in the books? Yes. Will I consider for tax purpose? No. So, it creates a difference. But this difference, once created, will never ever reverse in the future. That is called a permanent difference. So, that is one. Another example could be if there is something in the nature of penalty, etc., which is disallowed under section 37, then once disallowed, it will never be allowed. That is also a permanent difference. Whereas, if something is disallowed under section 40 IA, I have written the correct section. Okay, this is with respect to, let us say, TDS. Now, if something is disallowed with respect to TDS, for example, you made payments to some contractor, you did not deduct TDS, and the amount is disallowed. What is the amount disallowed if I don't deduct TDS under section 194C? If I don't deduct TDS under section 194C, what is the amount of expense that will be disallowed? Yes? Can you type it out? Because I am not able to hear my, turn off the speakers, so you need to type it out. Guys, you are writing examination. I expect you to, give me answers. If 194C TDS is not deducted, what is the amount of disallowance under Income Tax Act? I am waiting for an answer. 30%. Very good. Finally, you got the answer. Okay, why did it take so long? I don't know, but yes, 30% is disallowed. Now, this disallowance, is it a permanent disallowance? Is it that they will never allow us that expense? No. This 30% disallowance will be subsequently allowed in the future. So, this is called timing difference. Okay, same way we have one section called 36, I think IV, I don't know, some section under 36 where PF of employees. If employees' share of PF is not contributed within the due date, it is disallowed. And recently there was an amendment which said it will never be allowed in the future. It will never be allowed in the future. So that is a permanent difference. Now, permanent difference basically means that even if you pay higher tax today, in future you will not get any benefit. So that is what is called permanent difference. Okay, permanent difference does not create deferred tax impact. So there is no deferred tax liability, there is no deferred tax asset. So for us, what we need to understand is whenever we handle examination question, first we need to check, are there any differences? Then step 2 will be whether it is permanent or temporary. If it is permanent, ignore. If it is temporary, step 3 would be whether there is a higher tax today. If it is a higher tax today, then it is a DTA. If no, then it becomes a DTA. This will complete, or this will help you revise this chapter thoroughly. Are we clear? Okay, right? So that is how we have to approach a question considering the differences. So let's have a look at some of the illustrations. Financial year ending on 31st March, 1st of April of year 1, purchase of machinery 1,50,000, useful life 3 years, expected scrap value 0, IT depreciation 100% in year 1. In the first year itself, we'll get 100% deduction from this particular machine. Accounting depreciation is SLM. SLM means what? 1,50,000 divided by 3, it becomes 50,000. Profit before depreciation every year is 2 lakhs. So every year profit before depreciation is 2 lakhs. Tax rate is 40%. Now let us see how does it work. Sorry. Profit before depreciation every year it is 2 lakhs, 2 lakhs, 2 lakhs. Anyways, it's given in 1000. Depreciation for accounting purpose. So, as far as books is concerned, every year 50,000 depreciation. 50,000, 50,000, 50,000. Profit before tax becomes 200 minus 50, 150 every year. Okay. Now, when it comes to taxation, taxation says we will give you entire amount 100% as a deduction in the first year itself. We'll give 100% deduction in the first year itself. Now, when we give 100% deduction in the first year itself, now here profit before tax is 150, depreciation we have said 150, only 50. Tax says take 150 as depreciation. Means what? 100 of extra depreciation. So 150 is the total depreciation. Profit before tax is also 150. You get extra 100 of depreciation. So taxable income is 50. Or if you want to do it other way, what you can do is profit before depreciation is 200. From that 200, take 100% deduction of income tax of depreciation. So this will be 50. Profit before tax will be 50. Okay. Now on this 50, 40% rate when it is applied, you get 20. This 20 is called current tax. Once again, I have profit before tax of 150. I get 100 of extra depreciation. So my taxable income becomes 150 minus 150 multiplied by 40. I get 20 as the current tax. I am paying a lower tax, but I have to pay a higher tax in the future. I have to pay a higher tax in the future. If I have to pay a higher tax in the future, it will be a deferred tax liability. Now, what is the amount of higher tax? We have to see what is the difference. First step, identify the difference. Depreciation as per taxation 150, as per accounts 50, difference is 100. Difference is 100. Now, is this a temporary difference or a permanent difference? This is a temporary difference. I am paying lower tax now, so I have to pay a higher tax in the future. So this will be result in a deferred tax liability. 100 multiplied by 40%, 40 becomes deferred tax liability. Now this deferred tax liability, what I will do, I will add it to my expense. So deferred tax. So this is called, this is the current tax, this is the deferred tax. Total will be 60. Total is tax expense. Now in examination, they may ask you, calculate the tax expense. When they say calculate the tax expense, you have to calculate current tax as well as deferred tax. If they say calculate only deferred tax, you will calculate only deferred taxation, right? So this is the first year. In the second year, what happens is you have 200 of income before depreciation, 50 is the depreciation, 150 is the profit before tax. Now when it comes to taxation, taxation says I have already given you deduction. So this 50 of deduction is no longer allowed. This 50 of deduction is no longer allowed. So on this 150, you will add back 50, which will make the taxable income to be 200. Or what you will do? You can say profit before depreciation itself is 200. There is no further depreciation allowance. So this is the profit before tax. On this, when you apply 40%, you get 80. This is my current tax. So current tax is always taxable income multiplied by the tax rate. Taxable income multiplied by the tax rate, which is 80. Right? Now, what happens to deferred taxation? In deferred taxation, see, there are two ways to approach it. Depreciation as per books is 50. So, in year 2, depreciation as per books is 50. As per tax is 0. So the difference now has become 50. Now please understand, this is not a fresh creation of difference. Year 1 was 50, 150, difference was 100. this was created. In the first year it was created. In the subsequent year it is reversed. In the subsequent year it is reversed, right? So this is called reversal of deferred tax liability. See, one is creation. First time when it happens, it is a creation. Subsequently, if the difference gets reduced, it is called reversal. So what happened? 50 got reduced, reversed. If 50 got reversed, multiplied by 40%, 20 is the impact which is reversed. So here if you see, in the first year we created 40. Please understand this. This is one part where students make a lot of mistake. 40 is when we created, or when we created 40 was the deferred tax liability. After the end of first year, there is a reversal of 20. Reversal means I have consumed DTL of 20. Now when I reverse a DTL, it is reducing my liability. So I take it as a benefit. So my current tax expense is 80, which is 40% of 20. This 20 is the reversal. So my tax impact is again 60. My tax impact is again 60. Here current tax minus deferred tax, because I am reversing a liability. So I get 60. In the third year also same thing, 80 minus 20, 60. Okay. So sometimes if the question asks you for 3 years, first calculate current tax for all the 3 years, then calculate the deferred tax, and if there is a reversal of deferred tax, you should calculate that. Now in exam, if a question like this comes, this is a very simple question, you will also get marks for calculating current tax correctly, and you will get calculation of deferred tax marks, that also you will get. So for example, maybe 1.5 here, 1.5 here, and 1.5 here, around 4.5 to 5 marks will be allocated. Okay, that is how you need to calculate. So even for calculating taxable income correctly, you will get some marks. For calculating current tax correctly, you will get marks. For calculating deferred tax also, you will get marks. So again, a recap. First, see if there is any difference. Then see if it is a permanent or temporary. If permanent, ignore. If temporary, I will be paying higher tax today. If yes, DTA. If no, DTL. In the current case, we were paying lower tax today, so DTL. DTL, so when you calculate tax expense, you will say current tax plus DTL minus DTA. So what if we are reversing DTL? If you are reversing DTL, then when there is a reversal, you will do minus DTL plus DTA, which is reverse. Okay. Logically, if you think and practice 2-3 questions, you will be perfect in this concept. Any question? Okay. Now, when it comes to accounting treatment, current tax is an expense. Deferred tax liability creation is also an expense. These two put together will be the total tax expense. So what if there is a DTA? DTA you will reduce. DTA you will subtract while calculating the expense. Now, when it comes to DTL, whatever is the DTL, you will directly recognize, because you are creating an expense. So when you are creating an expense, when you are charging an expense, you directly recognize. But when it is a DTA, you have to apply the concept of prudence and check virtual certainty regarding future taxable income. What do I mean by that? See, when I am saying DTA, I have said that I am paying higher tax today, and in future I will pay lower tax. In future I will pay lower tax. Now in future, if I am expected to incur losses only, if I am expected to incur only losses, will I be able to get any benefit of this taxes paid today? I will not be able to take any benefit, right? So if I am paying a higher tax today and I have to create a DTA, in the future, if I am expected to incur losses, I will not be able to utilize the higher taxes paid, and hence DTA should not be recognized to that extent. Another example is, if there are losses today, what happens is, in future you can set off the losses. In future you can set off the losses. When you can set off the losses in the future, when you can set off the losses in the future, what happens? You will pay no tax at that point of time. So these losses that you have today, the accumulated losses which you have today, this also results in creation of deferred tax asset. But one thing that you have to keep in mind is, even though there is a deferred tax asset on this particular losses, if in future also I am expected to incur only losses and losses and losses, I should not be recognizing deferred tax asset. So the concept of prudence says that if I am recognizing DTA, it should be recognized only to the extent that there is a reasonable certainty of their realization. So I have to see whether can I realize the asset, only then I can recognize DTA. That's the first thing. Second, if an enterprise has unabsorbed depreciation or carry forward of losses under the tax laws. So as I told you, if I have carry forward of depreciation and carry forward of tax losses, in future I will have to pay less tax, and hence I have to create a deferred tax asset, right? Deferred tax asset should be recognized only to the extent that there is a virtual certainty supported by convincing evidence. This term you have to remember. Virtual certainty supported by convincing evidence that sufficient future taxable income will be available against which the deferred tax asset can be realized. So if I am recognizing losses, I have to see, is there a reasonable certainty or is there a virtual certainty? Is there a virtual certainty? In the future, I have convincing evidence that in the future I will make profits, and accordingly I will be able to realize the deferred tax. Only if this is satisfied, you can recognize deferred tax asset. Remember this term. If there is a theory question, you have to mention this without fail. So this is something which you have to remember. Okay. Now, we have seen what is the concept of current tax, what is the concept of deferred tax. First thing, subsequently, when you have to calculate the amount, what is the rate required? See, current tax is equal to taxable income multiplied by tax rate. What is the rate to be taken? For current taxation, you will take what is the applicable rate in taxes. Means for example, for your examination, finance budget of 24 is applicable. Not Jan 25, right? So finance budget of 23 is applicable. For May 25 students, my Finance Act of 24 is applicable. Correct? So what is the applicable tax rate and loss? What is the applicable tax rate and loss? Using the tax rate, you will calculate current taxes. But when it comes to deferred taxation, what you need to understand is, you will take the tax rates and tax laws that have been enacted or substantively enacted. Meaning to say, budget is presented in, let us say, February of 2025, for example. Okay. Now, when the budget is presented for February 25, assume for a moment, the parliament has passed, but president approval we will receive in July end. And you are preparing first interim financial statement, financial report for the first quarter. That is April to June. Budget has been passed by both the houses of parliament. Only technical formalities pending. This is called substantively enacted. So if already it has been substantively enacted, the rates that has been given, that rate will be considered for deferred taxes. See, for current taxes, there is no confusion. I know the rate, I will apply that rate. For deferred taxation, there is either enacted rate or substantively enacted rate, which should be considered, and you should not discount it to present value, because you cannot reliably measure when will the reversal happen. So this should not be done. And always remember, deferred tax asset or liability will always be shown as non-current asset and non-current liability. So rate to be considered: for current tax, the rate already enacted; for deferred taxation, the rate which has been substantively enacted. Only technical formalities are pending. Okay. Now, if at all a question comes on passing journal entries in the examination, we know tax expense is equal to current tax plus deferred tax liability minus deferred tax asset. Okay. So for current tax, the entry will be tax expense, which is a P&L item, to current tax payable, which is a balance sheet item. For deferred tax liability, you will have deferred tax expense, which is P&L item, to deferred tax liability, which is a balance sheet item. This is non-current, this is current. Okay, and if there is a deferred tax asset, you will have deferred tax asset to deferred tax benefit. Again, this is a balance sheet item, this is a P&L item. This also will be shown as non-current. So instead of deferred tax benefit and deferred tax expense, can I write tax expense? You can write. That is also allowed. Okay. Now if you see, tax expense plus deferred tax expense will make your total tax expense, or tax expense minus deferred tax benefit will make the total tax expense. Right? Now, if previously there are some unrecognized deferred tax asset, or if you have already recognized some deferred tax asset and you want to carry out a review, so what happens is, I have created a DTA. Okay, I created a DTA. Subsequently, I feel that this DTA cannot be recovered. Cannot be recovered. So what will I do? I will write down this DTA. Or initially I have not recognized DTA, or I have recognized at a lesser amount. Subsequently, I feel that I am making profits. I can recognize, I can realize this DTA. Then you will either reverse it or you will recognize afresh. So basically, both the DTL and DTA, they will be reviewed. They will be reviewed at the end of each balance sheet date to see if there is no certainty existing. I have already recognized DTA, but it is no longer virtually certain that future taxable income will be available. Write down. Previously, I have written down. Now there is evidence that I can realize it. Reverse it. I have not recognized in the past. Now I feel that I will be able to recognize it. Reverse it. Okay. So that is what it is done. In the balance sheet, deferred tax assets and liability should be distinguished from current tax and disclosed under a separate heading in the balance sheet separately from current assets and current liabilities. Basically, non-current asset or a non-current liability. In the P&L, what you will do is, you will show in the tax expense current tax separately and deferred tax separately. These two breakup is given. Any questions so far? No questions. Okay. Now, one more aspect is changes in tax rate. Okay. Let us say in year 1, depreciation as per books is 50,000. Depreciation as far as taxation is concerned is 80,000. So the difference is 30,000. Difference is 30,000. Now with this difference of 30,000, assume the tax rate applicable is 30%. So 30,000 into 30% is 9,000. Now because tax is giving me extra deduction, I have to pay a lower tax. In future, I have to pay a higher tax. So this will result in a deferred tax liability. Right? Now assume in year 2, there are no differences. Depreciation is same. But this tax rate has changed from 30% to 25%. Then what we should do? On this difference of 30,000, so you have to take the total cumulative difference, 30,000, you will apply 25% rate, and now you have the liability of 7,500. Initially liability was 9,000, now it is 7,500. So when the tax rate changes, you also need to revise the liability. When you have to revise the liability, it can result in either increase of liability or decrease of liability. Here there is a decrease of liability, means there is a reversal of DTL. So whenever there are tax rate changes, you have to reverse. You have to reverse or you have to add depending on whether the tax rate has increased or tax rate has decreased. Let's look at this question. Year 1, 1 lakh is loss. Year 2 there is a loss of profit of 50,000. Year 3 there is a profit of 60,000. Tax rate is 40%. Tax loss permitted to be carried forward up to 8 years. Now in year 1, if I have a loss of 1 lakh, what will I see? I will see, is there a virtual certainty that in the future I will have profits to take the benefit of deferred taxation? If yes, then in year 1 you multiply this by 40%, you have 40,000 of deferred tax asset. 40,000 of deferred tax asset in the first year. In the second year, what will happen? I have an income of 50,000, but I have a carry forward loss of 1 lakh. I have a carry forward loss of 1 lakh. So what will I do? I will set it off and my current tax will become 0. I don't have to pay any tax because I have brought forward loss. But I have already consumed 50,000 out of this 1 lakh. I have already consumed 50,000 out of this 1 lakh. So my carry forward loss will be equal to 50,000 only. 50,000 into 40%, I have a balance of only 20,000. So here I had a DTA of 40,000. Now I have a DTA of 20,000. So there is a reversal of 20,000 of DTA. This reversal of DTA will become my expense. Now see how beautifully the amount will match. 50,000 of income, reversal of 20,000 DTA. Basically, I am recognizing expense on account of 50,000 of profit. You can think of it this way as well. Then in the third year, what will happen? Another 50,000. See, balance is 50,000. Here profit is 60,000. So in the third year also, reversal will happen. In the third year, current tax equals to 60,000 minus 50,000 multiplied by 40%. So this is 4,000 and the balance of 50,000 gets reversed. So DTA reversal will be 20,000. So total tax expense will be equal to 20 plus 4, 24,000. Total tax expense will be 24,000. That also see how nicely it gets matched with the 60,000 of profit. So what you will do? In the first year, deferred tax asset, tax savings. Second year reversal, tax expense. Third year reversal, this also becomes tax expense. Current tax plus deferred tax will make the total tax expense. Okay, that is how the matching concept works when there is a profit, when there is a reversal of, or when there is a utilization of brought forward losses. Now, some questions and we'll see how to handle, how to quickly compute in the examination. The following particulars are stated in the balance sheet of Siddhi Limited as on 31st March of 22. Deferred tax liabilities credit 2.5, deferred tax asset debit 1.35. Now, one thing what you have to understand is, you will present in the balance sheet as net amount. So here DTL minus DTA 2.5 minus 1.35, you will present it on a net basis. If DTA is higher, that also you will present it on a net basis, right? The following transactions were reported during 22-23. So this is what opening balance. This is what opening balance. The following transactions were reported. Depreciation as per accounting records 15 lakhs. Depreciation as per tax records 20 lakhs. Now what has happened? Is there a difference? Yes, difference of 5 lakhs. Is it a temporary difference? Yes, it's a temporary difference. Now we have to see whether it will reverse or whether it will add, depending on how do we look at it. Now here, because there is no information of previous balances, you can treat this as a reversal or a fresh addition as well. Okay, so accounting records is 15, income tax is 20, difference is 5. Now, tax is allowing me higher deduction. If tax is allowing me higher deduction, my profit will be higher or lower? My profit will be higher. My profit will be lower. If my profit is lower, in future, I have to pay, today, I have to pay lower tax. In future, I have to pay higher tax. So this 5 will create what? A deferred tax liability. Second, interest paid to NBFC accounted in the books on accrual basis but paid on 30th of June. Now this you have accounted in the books on an accrual basis, but as far as section 43B is concerned, it will be allowed on payment basis. So this will also be disallowed. If this is disallowed, my income tax expense is higher, or taxable income is higher, accounting income is lower. So on this 6, it will create a deferred tax asset, because in the next year when I pay, I will get a deduction, and when I get a deduction, I will pay lower taxes. So always remember, if there is, for your understanding, if there is any disallowance of expense by income tax, this will always create a DTA. Just keep this in mind. If at all there is a disallowance under the Income Tax Act, it will always create a deferred tax asset only. Okay, so this will create a DTA. Items disallowed for tax purpose in 21-22 but allowed in 22-23 means previously it was disallowed. At that point of time, what would have happened? Previously in 21-22, this was a DTA. Okay, but now it will be reversal of DTA. So this will be a reduction from DTA. Donation to private trust. So assume this is disallowed and it is a permanent difference. So this will become a permanent difference. Tax rate 15%. So on all of this you will do 15% calculation, right? So now difference in depreciation, it will create a DTL. That is what we have seen here also. How much? 5 at 15%, 0.75. So 5 multiplied by 15%. Then interest paid. Oh, I missed it. This 43B, see how important it is to remember the timelines. This 43B, this will not be disallowed because this is before the due date. 30th June is before the due date of filing returns, correct? So because it is before the due date of filing returns, this will not have any consequence. My bad. I assumed that it will be disallowed, but now I recall, as per 43B, it will be disallowed if you pay it within the timeline of filing returns. It will not be disallowed. Then previously it was disallowed. Now it is a timing difference. It is a reversal of DTA. It is a reversal minus of DTA. How much? 1.05 into 15%. And here donation to private trust, permanent difference, it is not applicable, right? Then in the balance sheet it will be disclosed that DTL 2.5 plus 0.75, which is added 3.25, and DTA 1.35 minus 0.58, this number, and this has to be presented on net amount basis. Net amount will be whatever 3.25 minus 1.92 of DTL, which will be presented in the balance sheet. Any question here? Now here if you see, because they have not mentioned anything, you will apply the provisions of Income Tax Act of 1961. So some key provisions you need to remember. Don't think that, sir, it is an income tax, it is an accounting paper, why should we remember income tax? That approach will not. Okay.
It's 11 o'clock.
Then the following information is furnished in respect of Mohit Limited for the year ended 31st March of 22. Depreciation as per accounting records 56,000. Depreciation for income tax 38,000. The above depreciation does not include depreciation on new addition. So this is old only. A new machinery purchased on 1st of April costing 24,000, on which 100% depreciation is allowed in the first year for income tax purpose, whereas SLM method of depreciation is considered for accounting purpose. Estimated life is 4. So 24,000 divided by 4, accounting depreciation is 6,000. Just a moment. The company has made a profit of 1,28,000 before depreciation and taxes. Donation to private trust during the year 15,000 not allowed under income tax laws. Corporate tax rate is 40%. Right. Now here profit before depreciation and taxes is given as 1,28,000. Then Depreciation as per accounting record is 56,000 plus depreciation on new addition is 6,000. So 56,000 plus 6,000 will make it 62,000, right? Profit before tax 66,000. Now taxable income. Profit before depreciation and tax is 1,28,000, or alternatively what you can do, you can take profit after tax and do the reverse working. But if this number is already available, profit before depreciation and tax, it is advisable to use that. Minus depreciation 38,000 and 24,000, 62,000. So this becomes 66,000. So here it is same, see, 62,000, 62,000. Then donation, this is permanent difference. Donation is permanent difference. So 1,28,000 minus 62 is 66, plus 15,000 makes it 81,000. 81,000 current tax is 32,400. 81,000 into 40% is 32,400. Is there any deferred taxation? See, this is also 62,000. This is also 62,000. Is there any difference? There is no difference. So since there is no difference in depreciation, no deferred tax. Also 15,000 of donation is a permanent difference. So on this also no deferred tax. So you'll only have current tax and profit after tax, right? Now you ask me, sir, whether we should explain the provision. You have to see the number of marks. How many marks are there? 5 marks. For 5 marks question, and how many items are there? There are about 6 to 7 items. No scope for giving any explanation, or give a small one line. Give a one line explanation saying that interest paid to NBFC has been paid within the due date of filing return, hence it is allowed. And it is assumed that donation to private trust is not allowed for income tax purpose and is a permanent difference. 2 sentences you can mention, not more than that. Okay. If the same question is for, let us say, 8 marks or something, then you have to write more. Okay. Same question what we had seen earlier. See that they keep on repeating the question. Here they have said you are required to show the impact of the above items on deferred tax asset and deferred tax liability. Now when they have told you for each item show the impact, you have to do a working like this, and this analysis can be brief. You don't need to give a very detailed analysis. What is important? This number is important, and a brief analysis of why it is done. Okay, so let us do this. Depreciation as per books is 70 lakhs. Depreciation for tax purpose was 42 lakhs. There were no additions during the year. So 70 and 42. The difference on account of depreciation is a temporary difference, resulting in lower depreciation for what? Tax purpose. So either it can be a deferred tax asset creation, or it can be a reversal of deferred tax liability created earlier. Expenses disallowed in 1920 and allowed for tax purpose in 2021. So always remember, when expense was disallowed in 1920, it was DTA. Now it is reversal of DTA. Share issue expenses allowed under section 35D of the Income Tax Act for the year 2021, 1/10 of 70 lakhs incurred in 1920. Now if you see, 35D allows for how many years? If you remember, over a period of how many years you should allow the share issue expenses as per section 35D? This is 35D, okay, not 35 bracket D. As per section 35D, it is 5 years. Here they are saying 1/10 is allowed. So 1/10 of 70 lakhs is 7 lakhs. To that extent, it is reversed. The year in which it is disallowed, DTA. Year in which it is allowed, reversal. Then repairs to plant and machinery were made during the year of 140 lakhs and was spread over the period 2021, 21-22 equally in the books. However, the entire expenditure was allowed for income tax purposes. See, first thing is, this treatment itself is wrong. In the books also, you have to the repair expense has to be expensed in the year in which it is incurred. But still, they are saying 140 was split in 2021 and 21-22. We are dealing with what? 31st March of 20. No, we are dealing with 2021. Okay. So 2021, 21-22. 70 lakhs as per books, 140 lakhs as per taxation. Taxation has given us higher deduction. Means in future we'll have to pay a higher tax. So it will be resulting in a creation of DTL. We'll show this. Okay. Now if you look at this, following information has been provided. Depreciation as per accounting and tax is given. This will again result in tax is higher. So DTL. Right? Straightforward. Unamortized preliminary expenses 40,000. This is disallowed. So this will create a DTA because it will be allowed in the future. Very simple. definition and all you can do it. So here if you see, actual payment was made before the due date of filing return and allowed for tax purpose. So here they have given a detailed explanation. In the other question they have just given 30th June. So you have to be careful on how do you analyze. Again I am telling you, if nothing has been given, no information has been given on allowance and disallowance in the question, you will assume that it is allowed for income tax purpose. Can an enterprise offset deferred tax assets and deferred tax liability? It can offset deferred tax asset and deferred tax liability if the enterprise has an enforceable right to set off against liabilities representing current tax and the asset and liabilities relate to taxes on income levied by the same governing tax laws. So, as far as offsetting is concerned, deferred tax asset and deferred tax liability, you can offset it provided they are charged by the same taxation authority and the entity has a right to offset the assets against liability. Again, similar question what we have done. Okay. My pencil battery is low. I'll just charge it and we'll resume in a minute. Okay, so this is typically simpler questions are asked. There is no difficulty, very high difficulty level questions are not tested as far as deferred taxation is concerned. So even if you are comfortable with the type of questions we have discussed, you will be able to manage it. Just think of it. Is there a difference? Temporary, permanent? If it is temporary, benefit now or higher tax now, accordingly calculate DTA or DTL. Then we have one more concept of MAT, which is minimum alternate taxes. Right now, minimum alternate taxes it is levied under section 115 JB of the Income Tax Act. What it prescribes is especially when companies claim a lot of deduction, what the provision says, there is something called as taxable profit and there is something called as book profit under section 115 JB. Okay. Now the concept is, sometimes what happens, you claim a lot of deduction or there is a lot of brought forward losses which are offsetting, because of which the taxable profit will be lower, but the government does not want to leave taxation. The government says even if your taxable profit is zero or negative, but if there is something called as book profit, how to calculate and all of that is out of the question of the syllabus. Also for your intermediate, you will learn this in final level. But what it says is, say for example, taxable profit is 10,000. After claiming all the deductions available in the chapter under chapter 6A and brought forward losses and all of that, this is 10,000. On this, you are required to pay 30% of tax, which is 3,000. But as per books, when I say as per books, not accounting books, as per book profit of 115 JB, when you calculate using the provisions of income tax, this taxable profit under 115 JB becomes, let us say, 50,000. And on this, 10% tax is applicable. On this, 10% tax is applicable. What is 10%? 5,000. So, what the standard says is, the Act says, current tax is 3,000, book profit under 115 JB is 50,000. So, this 5,000 is called minimum alternate tax. This is an alternate tax. Sir, how many regimes to remember? We have to remember under 115 BAC, we have to remember 115 JB, we have to remember this. That is how it is. Okay. So, this is a normal tax. 3,000. Under provisions of 115 JB, you need to pay a minimum alternate tax of 5,000. So the income tax was, if this is higher, pay this. If minimum alternate tax is higher, pay this. So higher of current tax or 115 JB is payable. So how much will we pay? We will pay 5,000 only. We will pay 5,000. But now sir, we pay 2,000 extra. This 2,000 extra you can claim as credit in the future. 2,000 extra you can claim as credit in the future. I am repeating the concept. Taxable profit is 10,000. Tax on that is 3,000. Book profit under 115 JB is 50,000. Tax on that is 5,000. Government says pay higher. The extra amount that you pay, 2,000, this you can claim as credit in the future. This is called asset or MAT credit. So why it is called an asset? Because I can claim this in future, it is called an asset and I can utilize it. Okay. So with this concept, let us have a look at one question. The accountant of Sona Limited provides the following information for the year ended 31st March. Accounting profit 750, book profit 437. Profit as per income tax 90. Now this is as per MAT, means as per 115. Tax rate is 20%, MAT rate is 7.5%. Now you are required to calculate deferred tax asset liability and the amount of tax to be debited to P&L. Right? First, accounting profit is 750. So what you have to do? We have to calculate tax. No need to calculate tax on accounting profit. Calculate tax on book profit. Calculate tax on profit as per income tax. Calculate tax on book profit and profit as per income tax. Profit as per income tax is 90,000 into 20%. 90,000 into okay, I'll work it separately here. 90,000 into 20%, that is 18,000. This is what? This is tax as per normal provision. Okay. Then book profit is 437,500. On this you will apply 7.5%. So as per MAT, tax is 437,500 into 7.5%. That works out to 32,812.5 or 32,813. Which is higher? 1 or 2? MAT is higher. So the government says pay MAT. Government says pay pay MAT. So we'll pay MAT. Amount to be paid is 32,813. That is your amount that you have to pay. Okay. Now I have paid 32,813. I have paid 32,813. This becomes my current tax. This becomes my current tax. Okay. Then out of this 32,813 and 18,000, the difference whatever is there, 32,813 minus 18,000, difference between MAT and normal tax, 32,813 minus 18,000, I get 14,813. This I can take benefit in future. This I can take benefit in future. So 14,813 I will debit to MAT credit and I will credit to P&L 14,813 and 14,813. So this amount will be credited to P&L. Okay. So first we'll calculate the total tax as per normal provision and MAT 18,000 and 32,813. Whichever is higher will be debited to P&L. Then the difference between these two, which is 14,813, that will be credited to the P&L. So why are we crediting to P&L? Because it is not my expense. I will get a refund of this or I can adjust this in the future. So I will credit it to P&L and show it as an asset in the balance sheet. Technically speaking, only the net amount is shown. Okay, but the institute has framed the question in this way, and in fact, in the suggested solution, they have not even given this perspective. But you have to show it as an asset in the balance sheet. Then the next thing is, what is the deferred tax asset and liability? Now here they have given accounting profit of 7,50,000. They have given accounting profit of 7,50,000 and they have given profit as per Income Tax Act to be 90,000. Now this difference of profit, my income tax profits are lower, means I will have a lower tax now but higher tax future. That will create a deferred tax liability. 75 minus 9, so 0 0 0 and one more 0. 75 minus 9 is 64. 6,40,000 is the difference. On this I have to apply 20%. Sorry, 15 minus 9 is 6, 66,000. 20%, 66 into 20% is 132. So 1,32,000 is my deferred tax expense. So two things. One, what is the deferred tax expense? 1,32,000. And what is the current tax amount to be debited? 32,815. And also you will have to credit 14,812 or 14,813 as credit in the books. Is this question clear? The question on math. Please practice this question, because if at all it comes, it is 5 out of 5. 5 out of 5. See, the idea is to master such questions which will give us out of out in the examination. Other questions can be taken care of. Okay. So here also is a similar question, the thing, but again, they have said amount to be debited, it has to be net amount basis. There is a conceptual error in the question itself. Okay. Then there is another concept which has not been tested so often in the examination, but you should be aware of the concept on tax-free enterprise. So we'll look at the concept first, and then we'll come back to the question. Tax holiday or tax-free enterprises. So what happens is, you just no need to break your head what is section 80IA and all of that. Just remember the concept. Okay, here I don't want you to spend extra time in remembering the logic and all of that, because this is slightly advanced level. You can do it subsequently also. Okay, there are some things which we have to understand logically in detail. There are something we just need to remember and go and write in the examination. Objective is right now pass the exams. Okay, now what happens is, there is a concept called tax holiday or tax exempt enterprise. So meaning to say, if I am doing a specific kind of business, the government says for the first 5 years, your profits, everything will be not taxed. Your profits will not be taxed. First 5 years, profit will not be taxed. Now think of it, year 1, 2, 3, 4, 5. Year 1, 2, 3, there is a difference which has arisen between the accounting profit and the tax profit. This difference will reverse in 4, 5, 6, 7, this period. Now in 4 and 5, I don't have to pay any tax. So reversal happening here is irrelevant to me. Whatever reversal will happen subsequently, only that is relevant to me. So if there are timing differences which has arisen during the tax holiday period, in the first 3 years, there is a difference which has arisen. And if it is reversed during the tax holiday period, then the deferred tax should not be recognized to the extent of GTI subject to the deduction during the period. Basically what it means is, if differences arisen in this period and subsequently the difference has reversed in the tax holiday period itself, you will ignore. And if it reverses after the tax holiday period, deferred tax should be recognized to that extent in the year in which the differences originate. So if 1, 2, 3 differences arose, whatever differences gets reversed in 4, 5, ignore. If differences gets reversed in 6, 7, for that you will provide deferred tax impact. Okay. This summary you should keep in mind so that it is clear to you. So let us see this. Goodwill Limited is a full tax-free enterprise for the first 12 years of its existence and is in the 3rd year of operation. 3rd year better. Depreciation timing difference resulting in a DTL in first, second and third year is 200 lakhs, 300 lakhs, 400 lakhs respectively. 1, 2, 3. From 4th year onwards, it is expected that the timing difference would reverse each year by 10 lakhs. So from 4th year onwards till what? 12th year, even after that, reversal will happen at what? 10 per year. 10 will be reversed every year. Assuming tax rate of 35%, find out the DTL at the end of 3rd year and any charge to the P&L account. Now here what you need to understand is differences that arose 200, 300 and 4 year, and we are talking about end of 3rd year. So total differences is 500. Total differences at they have asked us end of year 3. This is year 1, this is year 2, this is year 3. So at the end of year 2, it is 500. At the end of year 3, it is 900. Means the total difference which has originated. Originated means 200 plus 300 plus 400. Total differences is 900. The question has asked us, find out the DTL at the end of third year and any charge to the P&L account. Okay, so we'll do for the third year. 900 is the total origination. Now, reversal will happen how? How will the reversal happen? 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 7, 8, 9 years into 10, that is 90 lakhs will be reversed. 90 lakhs will be reversed during which period? During the tax holiday period. Then, after that, whatever gets reversed after that will be, we will create a DTL for that particular amount. We will create a DTL for that particular amount. Now, think of it. The question is, again, find out the DTL at the end of year 3. So, how much should be the DTL at the end of year 3? Cumulative timing difference is 900, which will reverse during the tax holiday is 90, reversing beyond tax holiday is 810. On this 810, if you apply 35%, 283.5 should be the deferred tax, which should be the closing balance. Now, if you see the breakup, we have 200, we have 300, and we have 400. Out of this 200, 90 will get reversed because it is first in first out basis. Out of this, and 10 will get reversed subsequently. Out of this 300, entire 300 will get reversed subsequently, and out of this 400, entire 400 will get reversed subsequently. I am repeating once again. Out of this 200, 90 gets reversed during the tax holiday period and 110, not 10. I'll give a breakup here itself. Out of this 200, 90 gets reversed in the tax holiday period and 110 gets reversed subsequently. Out of this 300, entire 300 gets reversed subsequently. Out of this 400, entire 400 gets reversed subsequently. So 400 plus 300, 700 plus 110, that is what brings us to 810. So at the end of year 1, DTL will be 110 multiplied by 35%. At the end of year 1, it will be 38.5%. Then in year 2, 300 into 35% gets added. 300 into 35% is 105. That gets added in the second year, and 140 gets added in the third year. Balance at the end of the third year is 283.5. Okay, so that is how you have to calculate. Practice this. If it comes, a bonus question. Generally, they will not ask, but who knows? Institute, we never know. Okay, that is their thing. Again, similar concept here. Then they have added one unique type of question here. I just pull this up in the notability so that I can discuss this. ABC Limited had an investment in venture capital amounting to 10 crores. Venture capital in turn had invested in the below portfolio companies, new startups on behalf of ABC Limited. So investment is 2, 3, 4, 1. Total investment is 10 crores. Okay, 10 crores is invested. It is unfair for the institute to ask this question at inter level, but still, because they are given, we need to discuss. Okay. During 1920, venture capital had sold their investments in Star Limited and realized an amount of 8 crores on sale of the shares of Star Limited, and entire proceeds of 8 crores have been transferred by venture capital to the company. So now, please understand, the company has invested in VC. Company has not directly invested in these companies. If they are directly invested in these companies, we would have calculated gain on loss based on each investment. What we have to see is, we have invested in a venture capital. We have given the amount of venture capital, and which is 10 lakhs, and 8 crores of shares of Star Limited has been sold, and we have received the amount. The account managers has received the following additional information from the venture capital. 8 crores have been deducted from the cost of investment, and carrying amount of investment as at year end is 2 crores. So 10 crores was the total investment. We received 8 crores back. Now our investment is valued at 2 crores in the books. Company had to pay capital gain tax or 20% on the net sale consideration of 4 crores. So what they have done is the company has to pay tax. In the books, it is differently accounted. For tax, 8 crores is the sale proceeds, 4 crores is the cost. The difference on that 4 crores tax has been paid. This is called something called as pass-through transactions. Again, advanced level when it comes to intermediate. Pass-through transaction means the venture capital is not paying tax. The original owner will pay the tax. So I'm not technically directly owning Star Limited. Okay, but tax liability is falling on me. Due to COVID, the remaining startups, that is Oscar, Z, and Sony, are not performing and will soon wind up their operation. VC is monitoring the situation, and if required, they'll provide for impairment loss. So the remaining 3 they are monitoring. You need to suggest accounts manager what should be the correct accounting treatment as per AS 22. Okay, so here see, sale consideration 8, cost of investment 4, gain is 4. On this 20% tax has been paid, which is 0.8. Now this is my current tax liability. This is my current tax liability. Okay. Then there is a timing difference. What is the timing difference? Taxable income is 4. Income tax is saying you pay for your taxable income is 4. But in the accounting, there is no profit. Accounting, we are saying it is nil because we have reduced it from the cost of investment. So is it allowed or not? See, there is something called as equity method of accounting. Then there is a separate accounting for venture capital. All of that is allowed. Okay. It is more like a return of capital. I gave you 10 crores. You returned 8 crores back to me. Whether you return from this investment or that investment, as far as books of account is concerned, I am not bothered. But tax implication has fallen upon me. It has been passed on to me. So, the timing difference is 4. Timing difference is 4 means what? Accounting income is low, taxable income is high. We have paid higher taxes today. Now, this higher taxes today, whatever we have paid, will we realize this in the future or not? That is the first question. That is the first question we have to understand. The timing difference 4. On this, if you apply the tax rate of 20%, you get a DTA of 0.8. Now, this DTA, whatever I have created, I can show it as DTA in the books if I believe that in future I will get benefit. But they have said that the portfolio companies are not performing well, thus the company may not have sufficient future taxable income, which will reverse the deferred tax asset. Because future I will not get any income. So where is the question of reversal? And if reversal will not happen, we should not recognize DTA and only show current tax liability of 0.8. Okay, practice this. If they pick it up in the examination question, it will be a good help for you. Okay. So with this, we covered all the concepts and important questions of accounting standard 22. I will end it here because we have only around 25 minutes left. I want to complete accounting standard 11 also in a single stretch. I don't want to give a break on that. And then after accounting standard 11 tomorrow, we will start with accounting standard 4 and accounting standard 5. Okay. Any questions or can we end the session?